Good afternoon, everyone, and welcome to the first of 10 weekly seminars about entrepreneurship in Asian high-tech industries. The U.S.-Asia Technology Management Center at Stanford, and we are very happy to be the producers of this series. Our center is an industry affiliates program at Stanford, which means that we are supported by membership fees and other research support from our 23 member companies. And so we want to start by thanking our member companies for their support that allows us to do this kind of program. This series will be going on at this time every Tuesday through June the 1st. And take a look at our homepage, asia.stanford.edu, for the upcoming schedule of speakers and also previous videos and slides from previous sessions in the series. So what this series is about is to share and discuss the newest information we can possibly bring in on entrepreneurship and supporting ecosystems for entrepreneurship in Asian high-tech industries. And I'm very happy to say that even though we can't do this in person like we usually do, we're able to use this opportunity to bring in a live speaker every week from a different Asian country. So I'll talk a little bit more about the future sessions in the series as we go along. This series is open to the public. We're delighted when anyone can come in. You're most welcome. It's available for university credit to registered Stanford students. So there are 3 course numbers you can choose from. It's open to undergraduates and graduate students in all majors or departments. Because the content of this seminar course is different every year, it can be repeated for credit in future years. So please check the syllabus, which is on our website. It's also on the Canvas site for the requirements, which are simple. Basically, write a comment that shows you were not asleep during the session and send it to me within 2 weeks of the session. And yeah, that's pretty much the requirement. It is possible to watch this series this time purely by looking at videos, not in real time, but we hope you'll come in person or real time so that you can engage in discussion with the speakers. We will have a time of prepared remarks, then we'll have discussion time during the class, and at the end of the scheduled class, which is 5:50 in the afternoon, I'll stay around, and if we can ask them to, our speakers will stay around and we'll have a much more informal conversation with everyone who stays. So today's session is going to start out with just a couple of slides to put the whole series into context. Then we'll talk about entrepreneurial activity and attitudes toward entrepreneurship in major Asian economies. Then we'll talk about the ecosystems to support entrepreneurship and trends in those systems. And then we'll have some time for discussion today. So the first thing that really hits you about what is distinctive in regard to US-Asia business in the year 2021 is the tension between the United States and China. And you're seeing a lot of things that have developed over the last few years that make doing business with China more complicated. There are stronger export controls. There is the review by the Council on Foreign Investment in the US, CFIUS, before you can accept a foreign investor in a startup company or a venture capital fund. There is the entity list of prohibited business partners. And it takes months for a company to be sure that you're in compliance with these laws. At the same time, there's increasing government control on the China side. There was the denial of the IPO that Ant Group had planned. And this is probably more about regulating large IT firms than it was specifically about Jack Ma. And then there's all the situation in Hong Kong, which is very troubling to a lot of us. So the upshot for this course is that this increases the uncertainty, the feeling of uncertainty a great deal. And it may have had a negative impact on the amount of entrepreneurship and venture capital that is moving around. The people who are almost immune are the investors. The people who are in charge of PE funds, the people who are investing in markets in the other country, money is flowing like never before. So here is a bar chart from Rhodium and then the official estimate from the US Treasury, which shows that for investments by Chinese entities in American firms, and this is public firms as well as private firms, you have more than $2 trillion by Rhodium's calculation and more than $1.6 trillion by the US Treasury's calculation. In the opposite direction, Rhodium calculates that there's an awful lot of American money, 1.2 trillion going from the US to China this year. This was for the year 2020. And the official estimates were a lot lower, only about $300 billion. But Rhodium was calculating offshore companies in the Cayman Islands that are really doing business in China and so forth. So the business has not stopped at all, especially on the investment side. It's still quite active. The second thing that really hits you about where 2021 is that as we recover from COVID, Asian economies are going to continue to drive world growth. So world gross domestic product, the size of the entire world economy at PPP calculation was about $130 trillion in the year 2020. Of that, 24% was delivered by China, and 21% was delivered by the United States. So at PPP, China is already the biggest economy in the world. The US is number 2. Then if you're not counting the entire EU, you get India and Japan as the remaining top economies in the top 5. So sure enough, 2020 was a horrible year, right? Look at the minus growth that happened in all economies except China. And China had only 2% growth last year. But as a result of this huge drop down, probably the economies are going to have even faster growth in 2021 than they're sustaining over the long term. So China is expected to grow by 8% in 2021 and by 5.2% in 2022. The numbers in blue are faster, greater than the world growth prediction. And you notice that 4 out of the big 5 Asian economies are in this category. Their growth is predicted to be faster than the average growth of the whole world economy. Japan is 2.5%, 2.3%. A lot of people are worried about that, but it's worth looking at the European Union, which is 3.6%, a little bit better, right? And it's expected to go above world growth in 2022. But individual countries like Germany tend to have growth patterns about like Japan. So the point here, Asian economies are very large. Indonesia is currently the 7th largest economy in the world by PPP calculations. And they're going to grow fast as they continue to develop infrastructure in the more kind of developing economies, and as consumer spending kicks in, as the relative income per person increases in these countries. The third thing that is an impression, but it's something that I get watching the news pretty much every day, is that the entrepreneurship ecosystems in Asia have really started the huge hockey stick up of being much more robust than they were. I almost wanted to say they were becoming mainstream parts of the Asian economies, but that gets into a whole discussion of what's mainstream. The quality of the startup companies are definitely seeing more and more highly original business ideas, not just copies of things in Silicon Valley for Asian audience, Asian consumers. And I'm seeing this as being such a great thing because you get different approaches to solving problems, diverse approaches to innovation that really acquire their roots, have their roots in the different situations in different Asian countries. I'm also seeing more diversity in the founder teams. We'll talk a little bit more about that in just a minute or two. Along with the quality of the startups, the quality of the ecosystems to support the startups are improving. The venture capital communities have grown greatly in the last 5 or 10 years across Asia. And they're also becoming much more sophisticated. I'm seeing years of cross-border investment is now finally leading to domestic venture capital companies in Asia that are really operating on par with Sequoia or anybody else coming in from the Valley. But it's still early in the evolution. There's still a long way to go. You see these kinds of evidence for these trends in the results. So 5 of the top 10 IPOs in terms of how much money were raised in 2020 came from China, including the top 3, 1, 2, 3. And back in October of 2020, their CB Insights estimated that there were 490 unicorns worldwide, of which 171 were in Asia. And the number of Asian unicorns is up by 31 over 2019. So I did put together a table of the most valuable Asia unicorns. Notice that the most valuable unicorn anywhere in the world is ByteDance by this calculation. And Didi Chuxing also comes in top 10 in the world. US companies like Stripe are in between, and down around number 9 is the AI company Databricks. But India is represented, Singapore is represented in the most valuable unicorns in Asia. And this is something that we'll come back to in one of the sessions later in this series. So yeah, this is the situation. Now, how does this really relate to what's going on in entrepreneurship, activities, and also attitudes toward entrepreneurship in Asia? First problem is what kind of data you're going to use. Well, we're very fortunate that the Global Entrepreneurship Monitor is a huge project that has been doing 2 yearly surveys of almost 200,000 people worldwide every year. These are done by national teams. So the survey in China is done by Tsinghua University. The Japan survey is done by 4 universities in Tokyo with funding from the Japanese government, MEXT, the Ministry of Economy, Trade and Industry. And the global leading partners, Babson College and their 3 org partners in Chile and Malaysia and Korea, make sure that each national team complies with the procedures. They must survey at least 2,000 adults between the ages of 16 and 64 in each country. Otherwise, they don't report any results for that country that year. This has been going on yearly since 1999. And if you go to our website, you'll see I've been reporting on this Global Entrepreneurship Monitor for years. And it's really kind of fun to go back to 15 years ago and see what it looked like. They also did an update report after COVID that just came out last month. And they have a big website with a lot of country-specific data. So using that, what's an entrepreneur? Well, they are trying to look at avoiding particular models of entrepreneurship. I'm sure you're aware that you've got startup companies around technologies like Silicon Valley, and you've got 3 friends that decide to start a restaurant somewhere. And you've got the mom and pop store on the corner that's selling vegetables. All of those people can be considered entrepreneurs in some way. So to see who they're talking about in their survey, they have devised this definition of total early stage people who are in the T group are either actively starting a company or they're managing a company that has paid salaries for less than 3.5 years. The difference between starting and actually running is this line right in the middle. That's the firm birth, is when they start to pay salaries to somebody. And so they also include the people running companies like that for less than 3.5 years. And of course, you know, what happens to entrepreneurs after they have been running their company? They either keep running an established business or they leave and they come back and become potential entrepreneurs. They may even become investors. So this is the T rate, is what percentage of the working age population are engaged in this kind of activity. In the United States, we've seen a gradual increase in the T rate from 9.6% up to 17.4% in 2019. This is the most recent year that we've got the T rates for, pre-COVID. And if you look at the other big Asia economies, China started out quite a bit higher than the United States, but has been dropping ever since about the year, well, depending on whether you look at it, either 2012 when Xi Jinping became the leader of China, or more obviously from 2014 or 2015, it's really declined. India has pretty much tracked the United States chart, a little bit lower, but except for the years 2014 and 2017, where it went in the opposite direction from the US, this pretty much tracked the US. Japan has been low consistently. Now, 4.3% of the working age population up to 5.4% of the working age population may be an increase. It's not a lot. And the chart is not really going up and down. It's very stable. So this is kind of the biggest economies in Asia. What's going on here, we'll come back to why it's working this way in just a minute. The next set of countries in Asia to look at are the tigers. These are the places that used to be the jumping off points to China: Hong Kong, South Korea, Taiwan, and Singapore. And what you see in this group is that they are all, almost always, with one or two tiny exceptions, lower than the T rate in the United States. There are fewer entrepreneurs in the tigers. This is because they're going through economic development, especially a lot of cross-border stuff with China, that favored big company prestige. Parents want their kids to get great jobs in big companies. Hong Kong started out low, way down low, right? 3.2%, whatever, but has really moved up quite a bit. Yeah, where did Hong Kong go? We didn't get too many results from Hong Kong in more recent years. Taiwan has been relatively stable, around 8.5%. South Korea has largely tracked the US with some kind of lagging behind between, say, 2012 and 2016. And Singapore has started out very low, but has quite tracked up quite a bit higher to the US. Yeah, this is Singapore, I think. I have trouble with my own eyes with colors. Anyway, so that's the situation with the tigers. If you look at the developing economies, and especially Southeast Asia, what you see are T rates that, except for Malaysia, all stay almost consistently higher than the T rate in the United States. But you see a lot of up and down. Again, except for this period from 2009 to 2016 in Malaysia, which may have been a political problem. It may have been really being bitten badly by the 2008 financial crisis. But most of the time in a developing economy, you will see a relative then you see an advanced economy moving really fast. There are more opportunities. There's less worry about preserving established wealth, more concern with getting what you can get when, grabbing the opportunities you can grab. And so this is kind of the general pattern of who's involved in entrepreneurship. As you start to look at the demographics, you see that the T rate between women and men in every economy, there are more men entrepreneurs than there are women entrepreneurs. The ratios are the least different in the United States and in China. Taiwan's not too bad, but you notice that the most inequality, the fewest entrepreneurs are found in Japan and in South Korea as in comparison to the rate of men. So that's one way to look at. Another thing to look at in terms of demographics is the age pattern of the entrepreneurs. So the interesting thing about this is that in South Korea and in Taiwan and in Japan, you don't have many really young entrepreneurs. There are not many entrepreneurs in the 15 to 24-year-old age group. The 35 to 44-year-old age group has the highest T rate in South Korea and in Japan. And in the US, it's kind of a tie. But in other places, it tends to be a little bit younger. The 25 to 34-year-old age group has the highest T rate. And one kind of bizarre thing that I don't really know how to interpret is that the US, India, and South Korea have very robust entrepreneurship in the 55 to 64-year-old age group. Other places, man, these people are getting ready to retire. So it's quite interesting to me to see these kinds of differences in who's an entrepreneur. Generally, you would expect entrepreneurs to be on the young side of the population, and that's borne out with a little bit more shift toward middle age in Korea and in South Korea and in Japan. And yeah, so another factor in looking at who's an entrepreneur is what motivates people to become entrepreneurs. So there's basically two big motivations. You're either an entrepreneur in order to grab an opportunity, or you're an entrepreneur out of necessity because you didn't have another job. So obviously, in early stage developing economies, there are not that many salaried jobs to have. So there's a higher percentage of entrepreneurs in the population. You kind of see that in the developing economies of Southeast Asia. And the way that it works, this is now a comparison between 2016 and 2018, where the ratio of people who are motivated by opportunity as opposed to motivated by necessity is by far the highest in the United States. For every one person in the US who's an entrepreneur because they couldn't help it, you've got 6.9 people in the US who are entrepreneurs because they wanted to grab some opportunity. That's also 3.6 people in Thailand in 2018 were entrepreneurs to grab opportunities as opposed to necessity. What is interesting is that the US and Thailand and South Korea all reflect increasing opportunity-driven entrepreneurship, while in Taiwan, Japan, Indonesia, China, and in India, you see an increase in the number of entrepreneurs who are entrepreneurs out of necessity. So this is, the US kind of change really reflects the sort of perception of opportunities for entrepreneurs. This index, which was 6.9 in 2018, was only 1.8 in the year 2010. So Americans the opportunity learning. And that came in the attitudes of people who are not engaged in T, entrepreneurship. So in the survey, they ask people a bunch of questions if they are not engaged in early stage entrepreneurship. They ask them if they see good opportunities in their country for entrepreneurs. They ask them if they think they have the capabilities to be an entrepreneur. They ask them if they're not being an entrepreneur because they're afraid of failing. They ask them if they have the intention to become an entrepreneur within the next 3 years. So if we start with that one, you see that the T rate in the US very closely tracks the rate of people who intend to become an entrepreneur within 3 years. So that's pretty stable. That indicates that you're not going to see a whole lot of sudden change in the T rate in the United States. What you see that is truly distinctive about America is this growth in the perception of good opportunities for entrepreneurs over the last 15 years. So from 31% of the working age population back in 2003, now 67% of the population in the US, working age adults, sees good opportunities for entrepreneurs. The other thing to pay attention to in this graph is how confident we are about our own abilities. 54% then, 65% now of the people who answered their survey said that they thought that they had the ability to start a company, that they had what it takes to be a good entrepreneur. That's a very high percentage, by the way. We'll see that as we look over into Asia. The fear of failure in the US was about 35%. It's also gradually gone up, maybe because just awareness of entrepreneurship has gone up. If the perceived opportunities are so much better, maybe more people have to be kept out by failure, it would go even through the roof. In Japan, this is where you really it makes me sad. The actual T rate is low. The percentage of people who say that they intend to start a company within 3 years is tracking almost exactly like the US, almost exactly the same amounts. The fear of failure looks like a big deal on the way this chart works, but it's 43.5% and started at 40%. If you go to the US, that's only 5 or 6 percentage points different. What is really different in Japan is the perception of good opportunities for entrepreneurs. Only 10% of the people in their survey saw good opportunities for entrepreneurs in Japan. And that amount has not gone up over the last 15 years. That's really kind of sad. The other thing that has not gone up in Japan is perception of people's ability to be an entrepreneur. I think that there's a couple of things going on there. One could be cultural humility. You tend not to say that you do a great job in Japan. You start a speech in Japan by saying, I'm too weak to give this speech, but I'm going to do it anyhow. Mediocre nagara. And so this is one of those kind of possibly cultural things. What really just stands out to me is the absence of seeing opportunities. In China, you're seeing things all over the board, is what it looks like. The T rate has, as we've seen, gradually gone down since 2012. The intention of starting a company has stayed quite a bit higher than the T rate itself. In some years, much higher than the actual T rate. Assuming Tsinghua was doing a good job with the survey, and I don't have any reason to think that they didn't, this would indicate that either there's a lot of people who plan to be entrepreneurs, and then when they get around to trying, they stop before they actually form the company, or possibly possible that they're answering the people in the survey by saying they're interested because they think that's what the people doing the survey want to hear. That is a danger in this kind of reporting of attitudes. But the kind of distinctive things in China was this blip in 2011 and another blip in 2019, where the perception of opportunities and intentions to become entrepreneurs really spiked up in 2011. This was when the government made an announcement about mass entrepreneurship as one of the government kind of guiding policies of the future. And probably this past year, it has something to do with the perception of, the government's AI policy, which was announced in December of 2017. So artificial intelligence, indigenous innovation, made in China 2025, people are seeing incredible opportunities for entrepreneurs, way higher even than in the United States. And they're also seeing that they have the capabilities to be entrepreneurial. Their fear of failure is actually almost exactly the same fear of failure as it was in Japan. 44.7 versus 43.5. So fear of failure may be overrated as a reason that people are not being entrepreneurs. Anyway, this survey that is done by the Global Entrepreneurship Monitor does not distinguish the different goals of entrepreneurship in terms of whether you really want to grow a company like a Silicon Valley startup or whether you want to make something that you will leave to your children, leave the company to your children. Those kinds of different paths of entrepreneurship are not distinguished. And it's very important to make a difference between traditional small and medium-sized enterprises versus Silicon Valley style startups. The startups grow as much as possible and then exit. If I can show how that looks, at the first stage of the company, you have founders, they've got a vision, they get some startup capital, they're going to try to grow the company maybe 100% a year, every year through this growth phase, meaning they're doubling the number of employees. They're moving to prototypes that they can sell. They're getting a lot more capital early on. And, this continues all the time until the company is at exit. In this model, the angels are probably going to end up owning 25% of the company. The VCs will own 33%, 40% of the company. By the time the company exits, the people who started the company may only have 10 to 20% of the stock in the company. Silicon Valley investors drive the company strategy, often through confrontational board meetings. And they really are looking for maximum growth because they have to return maximum money to their limited partners. And from the earliest stage, the pre-seed stage, going to an angel investor, the founders and the investors are all thinking about exit. How much can this company grow before we exit it? So that's the Silicon Valley model. The traditional SMEs will typically stay small. This can be things like restaurants, it can be things like professional services, but it can also be niche places in a supply chain. The people who make the brake pads for a Toyota automobile. There have always been a lot of traditional SMEs created everywhere, as well as Silicon Valley startups. And you do have these kind of intermediate types now. I think the European pattern of entrepreneurship really focuses more on longer term intermediate growth. And a lot of these European companies stay what are essentially family companies. Companies like Swarovski, or that's a family company, or Robert Bosch Corporation, which is actually owned by the Robert Bosch Foundation, a family foundation. So entrepreneurs really have to define their own personal goals. So looking at ecosystem behind entrepreneurship is a really important thing to understand how you can interact with a company if you're trying to do business with them or you want to invest in them. So here's an example of a Silicon Valley startup, Square. Square is a great example of a Silicon Valley startup. In 2009, Jack Dorsey was in one of those periods when he had been fired from the board of Twitter. And so he had money and he had time and he got together with these people. They put their own money into it. We don't know how much they put in. Within a year, they had 150 employees. They had processed 1 billion credit card payments within a year and a half of getting their first Series A funding. They're getting money about every year, every 13 months or so. They're typically getting more money every time. The growth rate of what they're doing, 8x growth in the number of credit card transactions they processed in 1 year. And, then near the ending stage, though, they waited a long time to go IPO. And so they went IPO at a share value that was actually lower than their Series E and their Series D venture capital share value. So those people lost money. They raised 243 million on a market cap of about $3 billion. And the previous VC valuation had been $6 billion. Okay, so Series D and E lost money. Series A, B, and C made money even at exit. And the people who kept money in the company are doing pretty well. I checked yesterday and the share value is $207 for a market cap of 94 billion. Now, I checked last month and the share value was $260 a share. We've had a pretty volatile market and the market cap of the company was 120 billion. So it is kind of a risky business to be looking at these companies that are moving so fast. But that example of explosive growth is classic Silicon Valley. I don't see it in Asia nearly as much. What I see in Asia is rapid growth for the first 2 or 3 years, but then about the time the company starts to turn a profit, it gets focused on maintaining itself. It's almost as though the entrepreneur gets too happy too quick. And I've wondered why that happens. And I really think that it has to do with the pressure from the investors on the Silicon Valley model. They want to keep this growth going through this stage so that they maximize the value of the company at exit. So that this takes us to the ecosystems. The ecosystems to start a company comprise 3 kind of moving elements and one thing that you want to be there and kind of be stable. The 3 moving elements are people, capital, and knowledge flow, right? And then you want a good infrastructure. You need different things at the different stages in the company, in the startup company's life. At the time of creation, of course, you not only need founders, but you need advisors. Typically, these people will receive stock in the company, so they kind of become part of the team. The knowledge that you need to start a company not only involves having the knowledge of whatever technical basis you've got for your business, but also knowledge of business, knowledge of how to get to market. You need, money from somewhere. All over the world, it starts with friends and family money. And you need various kinds of things that make it easier to start a company. Physical space where you can share copy machines and share conference rooms. Lawyers and accountants who understand the problems of startup companies. These people are paid. And a lot of the first money in the company is going to go to pay off these kinds of professionals. The growth stage of the company is where we don't talk about this so much in Silicon Valley. Everybody talks about entrepreneurs, but the people who are willing to work in a startup company are arguably the people who made Square so successful. Employee number 200, right? One of my contacts, 200 something at Google, so he's done well. This growth stage, people who are willing to work in a startup company and who know how to deal with the chaos of 100% a year growth is probably the hidden secret sauce of Silicon Valley. You can't teach that kind of stuff in a business school. It's too chaotic. And so the experience of having seen startup after startup, half the people on my street are involved in startup companies now. Having seen this a lot, having experienced it a lot is probably the real strength of the Silicon Valley labor market. Under the kind of knowledge that you need to grow the company, things like lean startup principles, how to do a rapid prototype. In terms of management knowledge, investor relations becomes really hard because by the time a company gets to Series C venture capital, the investors may actually own more stock than the original founders. So the founders have to be very careful how they select their investors and how they interact with them. This is the stage where VC money is the real key. And of course, not only do you need physical access to markets, but you need legal and accounting companies who can deal with the craziness of startup companies. At exit, you really need a flexible labor market. One of the big benefits of Silicon Valley is that if your startup doesn't do well, you can probably get a job somewhere else if you can show that you did a good job yourself inside the crazy startup company. Post-exit opportunities for founders and employees are critical. Not only the founders, but the employees. So my daughter is now 35 years old, and she has averaged about 3 years per company. And so I think that I don't know anything, but it wouldn't surprise me at all if she moves on to the next company pretty quick. She's talking to me about a lot of places that look interesting. The knowledge at exit has to do with post-merger integration. If you exit by being acquired by a big company, is the big company going to be able to take what that startup company did and really create more value with it after the acquisition? Can the heart of the startup company continue after it goes public? Google is fighting really hard to continue to have the kind of energy of a startup company, despite being a huge, enterprise. The capital is either M&A or IPO. Actually, in the United States, it's 90% M&A of all the successful exits. And of course, you need the kind of infrastructure that will allow you to have an exit, whether it's successful or not. So in that regard, let's look at these three main elements. With regard to people, there are entrepreneurs in every society. There have been ever since the beginning of humanity. The growth stage is where you really see challenges in Asia. It's hard to get top quality people to come to work in someone else's startup company. And, attractive stock options and a very attractive looking business plan, trying to hire somebody in a startup company in Silicon Valley is almost like trying to engage an investor, because the person is going to take a little bit lower salary than they could get at a giant company because they will get stock. The incentivization by the startup companies is not as sophisticated across Asia. The wages tend to be cheap. There tends to be very few stock options. And so there's less cohesion in the teams. And in the places like China, where you've got these new giant firms, or also I would say some places in Southeast Asia, like Grab in Singapore or Gojek in Indonesia, or some of the unicorns in India, they're starting to drain off the good companies who would have gone to the startup companies if there weren't this rise in successful startups that have now become. Failure is often cited as a reason don't become entrepreneurs, but as I mentioned, I think the perception of lack of opportunities is a bigger problem. Lack of mobility in the labor market is a big problem. if it's really hard to find a mid-career job opportunity, you're going to be very careful before you leave your current company. And that applies a great deal in Japan, an almost great deal in Korea, and to a lesser extent in the developing economies that are kind of more rapidly moving. And China has a very liquid labor market. Is typically not as constrained, but parents are starting to be the conservative influence. They want their kids to go to work for one of the big companies. Entrepreneurs in Asia tend to stay with their company after exit. There are only a few serial entrepreneurs in Asia. One of the things that I'm seeing that's improving the quality of startup companies, though, is more active involvement of ex-entrepreneurs as advisors or investors in the next generation of startups in different countries. So that's the people situation. With regard to knowledge flow, everybody's crazy on innovation now. I mean, innovation is the hot buzzword everywhere, right? Governments all across Asia are really pushing universities to do more tech transfer to industry. They're pushing more, research institutions and places to start up companies. But most of the discussion is about tech transfer. It's not about the transfer of business knowledge. There is insufficient flow of business knowledge from the previous generation of entrepreneurs to the next generation, or from investors to entrepreneurs. And part of that is related to a cultural problem. Mentoring is not as well developed in Asia. Part of this is, I think, legacy of Confucian apprentice system. The master doesn't tell you how to do what you're supposed to learn. You watch the master, you copy the master. That lets you internalize what you think you're learning, but it means that you don't learn how to communicate it to the next person coming along. Part of that is also less confrontational board management relations. This is across the board in Japan right now, all the way up to giant companies like Toshiba, where Toshiba had to have a second extraordinary general meeting of shareholders this past year. And it was all connected to kind of management issues that management was not prepared to have to stand up to activist investors and defend. I think that especially in business to business domains, startup companies have more trouble getting to market. This is part of the knowledge flow, right? Market knowledge, except maybe in China. I think companies get less feedback from their business partners. Certainly not feedback that's intended to nurture. The feedback may very well be intended to say, that's not good enough. We're not going to pay for it. But you don't get a lot of help in the middle of the POC doing the proof of concept development. The startups in Silicon Valley seem to pivot better. They have an idea, and if they realize that the world is developing at a different pace than they expected, they will change their business model almost every year. That doesn't happen quite as much in Asia. And I think that the tech-focused startups in Asia may be too happy with their technology. I see a lot of startups in Asia that are founded purely by engineers, and they don't have enough business people in the group, and they tend to invest not enough in sales and in market development. So that's the knowledge flow. In regard to the capital and financing, yeah, friends and family money is universal. That you start the business with your money and the money of people who you can really ask to believe in you. Angel investing had been a bottleneck all across Asia, but you're starting to see an evolution so that there are more sophisticated investors now than there used to be, but still not quite up to the kind of Silicon Valley style mentoring that you see here. At the growth stage, you've seen an explosion of venture capital all across Asia, billions and billions of dollars. I've got a slide on that. The domestic VCs are becoming more sophisticated, but a lot of them have different expectations about exit. They're not expecting the giant exit like the investors here want. They're expecting early profitability so that they can return dividends to their LPs, as well as selling shares in liquidity events. The Silicon Valley influence is noticeable, though, and just a week or two ago, Sequoia announced that it's going to start investing more aggressively in Japan. Now, the interesting thing is their investments in Japan are going to be managed by Sequoia China. So instead of jumping off to China, you've got China as a place to jump off to Japan, which is an interesting kind of concept. Anyway, the exit patterns are very different. In the US, most of the successful exits are being acquired by big companies, whereas in South Korea and Japan is still most of the time by IPO. And in those exits, the entrepreneur may keep 50% or more of the stock in the company. Unheard of here in the Valley. It just couldn't happen. Nobody is saying it should be this way. This is just a pattern that exists. Worldwide, what has happened is the share of Asia funding, North America funding, used to be dominant. And, you know, Silicon Valley accounts for between 35 and 45% of all of the venture capital in North America. So from 70%, we've gone down to 50%. It was really China that was behind this huge bubble between 2015 and 2018, where the amount of venture capital in China invested every year was about the same as the amount invested in the US. It's really dropped back in China. The amount in Europe, the share of global venture capital by Europe has stayed pretty flat, around 15, 13%. Yeah, here's the situation in China that I was talking about, this huge increase in amount invested, and also the number of deals has really dropped. Notice that the amount invested lags a little bit. That's because this was the era of the mega deal in China. 2017 to 2019 was where you had lots of venture capital deals of investments greater than $100 million at the time. In 2020, the number of seed stage deals in China dropped by 45%. So that's a real indication of some sort of loss of either confidence or feeling that there's not as good opportunity. We go back to those attitudes that we saw from the Global Entrepreneurship Monitor. And I have to say it probably has to do with opportunity. There is an increase in corporate venture capital in China, especially by the giant IT firms. And Western investors in China report that they see improvements in the quality of startup companies. That's not just my opinion. Here's the COVID factor, right? Between the first half of 2019 and the first half of 2020, everybody except India and Indonesia dropped a lot of investment. The amounts were a lot less in the first half of 2020. And what was really happening in India and Indonesia were a couple of very large investments. In India, the total amount of money invested in this one company, Reliance Jio, accounted for, like, you know, the huge majority of all venture capital funding that year. The number of deals was down from 1,100 deals to 600 deals in India. Indonesia, similarly, there was this mega billion-dollar in Gojek this past year that accounted for a lot of that. Otherwise, yeah, it dropped. 2020 was a bad year. Corporate venture capital is something to watch in Asia because the companies are looking for strategic relationships as well as good investments. And one of the distinctive things about Japan has always been that the amount of corporate deals that involved corporate venture capital was about 70 or 80%. It's exactly the flip in the United States, where the percentage of deals involving corporate venture capital is really about 20%. However, most Japanese corporate venture capital is going to foreign companies, places like Silicon Valley, not Japanese domestic startups. Out of the couple of $1 billion of money that was invested by corporate venture capital, 45 million of it went to Japanese domestic startups, just a small percentage. In China, corporate venture capital is dominated by a small number of very large firms. I think one of the things that kind of concerns me as a possible way that the economy could develop in China is that it might turn into an oligarchy, kind of like the Japanese keiretsu or the Korean chaebol, have a dominant position in the economy of the country that actually has a negative impact on innovation. But there is a shift among these big companies away from having the general partner role in an investment to taking a limited partner role where they don't have any direct management say in other funds, but they do tend to be rather activist investors. Here's the slide on exits. So this is the percentage of M&A deals versus IPOs of venture-backed startups in the United States. So in 2020, there were 120 IPOs by venture capital-backed startups in the United States, but 606 M&A of venture-backed startups in the US. In contrast, in Asia, you see that it's much more right around a half. And it stayed that way from the year 2013 to the year 2020. So this is an indication that the big companies aren't playing in this entrepreneurial ecosystem like they do in the United States. Google will buy 25 companies a year. They're not all as big as Nest or something like that, but they will be buying these companies to further strengthen their pipeline of innovation going to market. And that has not started to happen in Asia yet. So in conclusion, yeah, entrepreneurial activity has always been a part of economies throughout Asia and everywhere else in the world. I do think you're seeing a shift from necessity-driven to opportunity-driven motivations. I think Japan's very low T rate is definitely related to perception of few opportunities more than to anything else. And, you know, the improvements that the evolution that I've seen in the last 10 years of teaching this course has been remarkable. The things that are still missing are kind of good workers, still needs to have some more sophistication among investors, and especially the big companies need to learn how to play this game better. So a brief postscript, I think that after a horrible year 2020, the predictions from the IMF and from the World Bank are that 2021 will probably see a faster than average growth rate as we spring back. The losses are also being mitigated by the fourth industrial revolution, where companies are really learning how to grab the data, the value from the data that they're collecting. Shift of new ways of working. You've got winners, losers Um, you, I think that global business is aiming at more resilience. The US-China friction is not really keeping companies out of China, but it's encouraging companies to invest in factories elsewhere. So Intel's building a couple of new fabs in the US, but also Southeast Asia is a very big target in that regard. This year is more important to kind of keep the spirit of entrepreneurship alive than even usual, but it has to fit into this larger relationship so that the new ideas can reach their maximum potential. Sometimes the maximum potential is found through partnership with a big firm in some way. That's something where the US is still the model. And it's another realm in which Asia needs to grow more, and I think it will grow more. So that's what I have for my prepared remarks. Maybe people had some questions by chat. Thanks very much for your attention. One thing I forgot to do is to tell a little bit about what we've got coming up in the series. Next week, we have a panel of 3 speakers, including Ms. Minette Navarrete, who is very successful as the CEO of the Philippines' largest accelerator. This is Kickstart Philippines. 2 weeks from now, Stanford alum who has been representing the Stanford Hospital in China is going to come back and talk about healthcare entrepreneurship in China. I'm looking forward to see Shiheng Chen again. Shiheng is a long-term friend, and I'm delighted he's coming back. On the 20th, we have Ms. Fujio Ishiguro, who started her company in Tokyo in 1998 and took it public. And she's going to talk to us about kind of the whole situation for post-public company management or post-IPO company management, and how she is getting involved as an investor, including as an impact investor in new kind of startups. On the 27th, we have another Stanford alum, Alex Liu, is going to talk. He is the CEO of MyCoin, which is a cryptocurrency Bitcoin exchange, not Bitcoin, cryptocurrency exchange based out of Taiwan. And so Alex will be coming to us from Taiwan. On May the 4th, I'm asking Dr. Amit Kapoor, who has been working with us as a visiting scholar at Stanford, to talk about the rise of entrepreneurship in Asia, in India. And on May 11, I have Ms. Clara Chang and her CEO partner are going to talk about a new K-pop related startup company in Korea. Got a couple that I'm still finalizing I shouldn't talk about, but Dr. Lerwin Liu is going to talk about her work with an accelerator for the circular economy that she's running out of Bangkok, Thailand. Dr. Liu is from Singapore, but she's really all over the place. So those are the kind of things coming up. So I see that, first of all, Chan Chen has sent me a question. Are Chinese startups moving faster than Silicon Valley ones for IPO? Why is the case? Actually, it's hard to get that as a graph. The time to start up company in China and the US is not too different, is my impression. Now, I really should go back and take a look, but my sense is that the average is probably around 6.5 years, maybe 6 years now. In other countries, much longer to IPO in India and also in other Asian countries. So great question. Yeah, I should see if I can find that out. Rushton Hurley asks, has the comparative resistance to entrepreneurship in Japan been consistent over time? Or was there a period in some part of the 20th century when there was more interest in starting businesses? Well, I would say right after the war, people didn't have much choice. And this was a classic case of how entrepreneurship of necessity led to the first generation of very successful companies in areas of strategic interest to the Japanese government in the late 1950s, early 1960s. And then they became so prestigious that that's where parents wanted their kids to go to work. That becomes a really conservative factor against entrepreneurship. And it's really only been with great government pressure since about the year 1995 that entrepreneurship is finally kind of taking off. Great question, Rushton. From Paolo. Chinese investors are coming to Brazil, but are not investing in startups. They are targeting big companies in the stock market. Can you comment on that strategy? Yeah, that's kind of implicit in what I showed with that column bar chart of how much equity Chinese investors had in American stocks and vice versa. A lot of that is public company. And what it has to do with is how you're investing your money for financial return as part of a portfolio. I think there's still a sense in China that there are so many domestic market opportunities in China that a lot of the venture money is going to stay in China for startups, going to startups. It's big company returns that are relatively lower risk, but indicate a mutual belief in each other's economy, where you're really seeing companies wanting to keep very active global investment. And the people I've talked to who've been the most critical of American, policies about kind of decoupling from China have been the larger scale investors, even more than the venture capital companies. It's really been the giant financial institution investors who are doing that. So their purpose for the investment is financial return, possibly market entry. One of the classic ways for Chinese companies to internationalize is to buy into a local partner and then gradually learn from them until you essentially have a controlling interest in the local partner. If you've got the money, you can do it with a big local partner. From Maurizio, how does entrepreneurship align and change in relation to the past 4 years under the Trump administration? Geopolitical relations changes, US, China, USA, Russia, whatever. Think TikTok and Oracle. Yeah, right. Well, it's definitely had an impact. And I think that on the one hand, the people in areas that were really flowing out of the US, like semiconductors, why build a semiconductor company in the US was a question that not many people could convince investors to believe in until recently. And that recently has a lot to do with the policies of the Trump administration. I think that so far, I have not seen the fragmentation of Asian markets and Asian technologies and Asia kind of spheres of influence away from globalization that I was kind of expecting in the past administration. If the Trump administration had continued for another 4 years, I think we might really see a lot more splitting up and fragmentation. But it kind of ended before that really happened. Great question. That seems to be about it. I would be happy to answer a couple more if people have them. If not, we can call an end to the formal part of the program. Remember that in usual weeks, the class time ends at 5:50 in the afternoon. And we'll stay around and talk informally with whoever would like to stay and talk. So thanks very much for your attention this time. I look forward to seeing you next week with our panel from Manila.